Okay, welcome back everyone. If you've got any questions on the reweighting, I would suggest maybe chat to your CROs. As I see there's a lot of confusion regarding how the reweighting would have worked. But normally how it works is they would just take away the 20% and then they would reweight. So they said the ICE remains at 10%. So the things that would be reweighted is your test and your exam, which would then have been out of 80 if we take the 20% for test one away. So that would then have increased your test two and your exam to a little bit higher. But I would suggest just chat to your CROs, and if you don't come right there, maybe just contact the PM for your specific program to just give you the relevant information so that you know exactly what the weighting is when you prepare. Okay, so I think let's start with question 4.4, which is the more practical one, and then we'll flip back to question 4.3, which is the theoretical question on how to answer if something is gross income or not. So the first thing when you get a question like this in an exam, in a test, is you need to go read what is the UR required. So what do they actually want from you? So in this case, they said calculate the tax liability for Mr. Edmonds. Now tax liability is after we've done the taxable income and applied the tax tables. So in order to actually know what you need to do is you need to know the lingo to understand what is the question actually asking from you. In this case, it counts 20 marks. So that means generally a mark a minute. So you would have to do about 20 things to get a mark. Now, generally with a calculation question, some of the calculations, because they are a bit more complex, a specific line item can sometimes be 2 or 3 marks in that case. Then what was very important is they told you it's a South African resident. So that means I would include worldwide income. So that means any foreign income will have to be included when I do the calculation. So now we go to the beginning of the question and we go read through the information. So now I know what I need to start looking out for. I'm looking out for gross income. I'm looking out for exempt income. Any deductions, any capital gains will need to be taken into consideration. Now, the first thing you have to note here is Mr. Edmonds is 61 years old. Now, why is this important? It is important for certain of the exemptions. We need to know what is his age. Now, because he's under 65, that would mean his interest exemption, if he's got interest, would be limited to 23,800, and his tax rebate that he would receive would only be limited to the primary rebate. He would not be entitled to claim a secondary or tertiary rebate. So that is why that information is important. Then they tell you he's trading as a sole proprietor. So that means we have to include the company's income as well. So we're not only going to include, for example, if you earn the salary income, you're also going to include any income and expenses. Let's say income and expenses of the company as well. So that is what that information is basically telling you. Now let's read through what information they have given you. So they told you dividends of 10,000 from a South African company listed on the JSE. Okay, so we know dividends is included in gross income. Okay, so we're going to put it in gross income. Now the question is this one actually exempt? So this is where you need to actually go study to know if this will be exempt or not. Now that is where you had to remember the 4 items. If it's one of those 4 items, it would not have been exempt. Okay, now generally a company listed on the JSE would be exempt from the dividend would be exempt from the gross income. You would say put it in gross income and then you would put in an exempt income. Let's look at the next one. We've got foreign dividends of 11,000. Okay. Now we know foreign dividends, some of them are completely exempt and some of them are only partially exempt. So we know it goes into gross income. Now we have to go read this foreign company, which had owned 30% of the shares. And it is not a controlled foreign company. So we said if it's a controlled foreign company, it's completely exempt. If we own or own more than 10% of the shares, it would be exempt. So in this case, we also got gross income, and then you also have to go think, okay, is it potentially exempt? What portion of it is exempt? Okay, but that is now based on the information here. Then we've got foreign dividends of 18,000, but we only own 5% of the shares, and it's not a controlled foreign company. So in this case, we know it's less than 10%. So we're going to go include it in gross income, but in this case, we only have a partial exemption. I'm just going to make this a little bigger here. Then the next foreign dividend we received is 8,000 from DPLC, a foreign company that has a dual listing on both London and Johannesburg Stock Exchange, in which we own 1% of the shares. Now, generally, if there's a dual listing, that would also be exempt from foreign dividends because of the dual treaties between the countries. So generally, in that case, it would also be exempt. But you include it in gross income and then exempt. Then we've got interest of 13,000 that we've earned. Now, this is where the 61 years of age is important. So if you are younger than 65 years of age, your exemption would be limited to 23,800. Now, what that means is if it is less than that amount, you would only be allowed to get an exemption for the lesser of the amount. So that is the maximum that you would be able to get as an exemption, but amount lesser than that would be limited to the lesser of the two. Then we've got furniture sales of 850,000. Now, in this case, because he's a furniture shop, their furniture sales is seen as assets similar to trading stock. Which is a specific inclusion into your gross income. Okay, otherwise you would have thought it is capital of nature and you would have excluded it, but because of the fact that it's similar to trading stock based on the nature of the business, we would specifically go and include it into gross income. And then the last one is your deductible business expenses was 45,000. Now, because we haven't done the expenses, they've just given you the total expense amount. Now, when you do a question like this, I want you to do a framework. Let me just open the Excel so we can I'm just quickly going to just open the Excel this side. Okay, can you guys see the Excel on the screen? Can you just give me a thumbs up if you can see it on the screen? Okay, so normally with a question like this, what I want you to do is start with the framework. So you give the different indications. So is it gross income? Is it exempt income? And then the deductions, and then you fill in the information. Now I've included the tax tables. Now because of the fact that this question says it's for the current year of assessment, they need to be a bit more specific, but in the current year of assessment, so our current year of assessment for this year is the 2022 year of assessment. But if you are busy doing the calculation for the year of assessment that is currently being submitted to SARS, it would actually be the 2021 year of assessment. So I have done the calculation for both, but in a question they need to be a bit more specific, but the tables they would give you would be the correct year of assessment. So it would actually indicate what year you are busy with. So the first thing you have to do is we have to go work out what is the gross income. We want to know what is the gross income amount, and then so we include all the amounts, whether they are specifically included in gross income or based on the definition or as a specific inclusion. So if we look at the first thing, we know we've got dividends from a South African company of 10,000 Rand. So we would go and specifically include that dividend of 10,000 Rand. Okay, so that's a special inclusion. So we include 10,000 Rand for the local dividends. Just see where I've got exempt income brackets. Now, the first thing you have to look at for local dividends, we said if it is from a JSE company, it would generally be exempt in full because it's not one of the items that are on the list that is specifically excluded from the exemption. So we would use a section 10(1)(k) exemption for the local dividends. So that full 10,000 would be a negative amount. Okay, so you first go put it into your gross income. So you include it in the gross income and then you take it out of the exempt income. You do not leave it off completely because otherwise you would lose the marks that was allocated for it. So in this scenario, you would have received 1 mark for including it in gross income, 1 mark for specifically excluding it. If we then move over to the second item, we've got foreign dividends of 11,000. Now we said we have to include it in our gross income because of the fact that we are a South African resident, so we are taxed on our worldwide income, but we own 30% of the shares. Now we said based on the rules, if we earn 30% of the shares, we are actually, it's more than the 10%, so we would get a full exemption in terms of section 10B. Because of the fact that we own more than 10%, the full 11,000 would be exempt. Then if we look at the next set of foreign dividends, which is 18,000, here we tell you we only own 5% of the shares, which is less than 10%, and it's not a foreign controlled company. So now we know we won't have a full exemption, we only have a partial exemption. And based on the rules for a partial exemption, we would have to look at what type of entity we have. Now we've got a natural person and we've got a juristic person. So in this scenario, we will then go work out the exemption based on the natural person because it's a sole proprietor. We use the natural person's exemption, which is 25 over 45, and we multiply with the amount we've included in here, the 18,000, to work out the portion that would be exempt in this scenario. So let's just quickly cut a code here so that you can see which exemption and gross income goes together. Okay. So in this scenario, because of the fact that we have only 5% shareholding, it's not a foreign controlled entity, we would use the partial exemption. because they told you it's a sole proprietor, you use the natural person's ratio rather than the juristic person one. If it was a company, we would have done it 13 over, I think it's 28 for the company. Then the next foreign dividend is 8,000 Rand. Now in this scenario, we say it's a dual listing and we own 1% of the shares. Now we said for that, we would also include it into your foreign and your gross income. It's a specific inclusion. Okay, so let's make this one blue. But the exemption here would also be an entire exemption because of the fact that it's a dual listing. So this would be taxed on the stock exchange. There's an agreement between the different countries, and for that fact, we would actually then specifically exclude it from our gross income. Then if we go to the interest, we said we earn interest of 13,000 as an individual. Because we are trading as a sole proprietor, we are then allowed to get the individual, the natural person exemption as well, but it's limited to 23,800. So that means the full amount of interest is included in gross income based on the fact that we've received it. But then the exemption is limited to the actual amount and not 23,000. So in this scenario, you will only be allowed to deduct the 13,000 and not 23,800. So what a lot of students do sometimes is they remember about the 23,800, but then if the amount is smaller than that, they include 23,800. So just remember, you can never have a bigger exemption than what you've included in the gross income at the top. Okay. If the gross or the local interest there, let's say that was 26,000, then this amount here at the bottom would have been limited to the 23,800. Okay. So always remember, it's the lesser of the 23,800 or the actual amount for this interest exemption if we have an individual. So let's see what else. We've got our furniture sale of 850,000. Now we say that's a specific inclusion because it's similar to trading stock because of the type of business they have, the furniture shop. So we include the trading stock or the furniture sales in gross income for 850,000. And then the last thing is they tell us we have a deduction for business expenses of 45,000. So that is any expenses we incurred in selling that furniture sale, we would be allowed to deduct as well. So let me just give you the totals for gross income. So what you normally do is you add all the gross income together, add all the exempt income together, and then work out the income amount. And then you deduct the business expenses from it to work out your taxable income for that period. So in this scenario, our taxable income is 813,000. But that's not what they asked you. They asked you for the tax liability. So we need to go work out what is the tax based on that taxable income. And this is where the tax tables now come into play. So you start out, if we do the 2022 year tax year, let me just make this smaller so you can see the tax tables. So if we do the 2022 tax period, you'll see the taxable income is a sliding scale here at the bottom because we use the individual tax rate. So in this scenario, we have an amount of 813,000. Now what you have to go do is you first start with the left-hand side of the table, which is your taxable income. Then you go look at where does that 813,000 actually start in. So that would be in this category between the 782,000 up to 1.6 million. That amount is in there. Then you move to the right hand side. That is where it explains to you how to do the calculation. Now that first amount here, the 229,000, that is the tax that you would have paid on the previous category if you were at the maximum, at the 782,200. So that is the tax for 782,200. Then we add 41%, but only for the taxable income above that amount. So anything above 782,200 will be taxed. So that is the difference between our amount, the 813, less that multiply with 40% will give us the additional tax we need to add to this 229 to get the full tax amount that is outstanding. So in a test, it is important that you show the calculation, because we normally assign a mark for that tax amount. You get a mark for the percentage, and then you get a mark for this calculation. Now, if you've made an error, let's say yeah at the end, but you got the other things correct, I can still give you marks for that. So that is why it's important to show your calculations so that we can still give you method marks even though you made mistakes. So what you do is you put the tax that we would have paid up to 782,200 at the front. You add 41% of the difference between our amount and the upper category of the previous line item, and we multiply that with 41%, and then you work out the tax amount is 241,717. Okay, but because of the fact that we are an individual, a sole proprietor, we are allowed to get a primary rebate of 15,714 based on the 2022 tax year, which means our tax liability that we need to pay at the end of the year is only 226,003 rand. So this is based on the latest tax table. But let's quickly look at the one if it was last year's tax table. You would do exactly the same calculation, but based on that tax table, you would be in this line item. So last year, if you earned up to 744,800, any amount above that would only be levied at 41%. So you do exactly the same calculation, but your rebate for the 2021 tax year was only 14,958 rand. Okay, and then you work out your tax refundable is 231,143. Now for your test, you need to know these rebates amounts. They do not always give it to you, but they will give you the tax tables. But in this case, I've indicated what the rebates were, but sometimes they don't actually give it in a test. So just make sure that you know what the primary, secondary, and tertiary rebates are. If you're unsure what the latest amounts are, you can find it on SARS website under the tax rates tab. You will find the latest scenarios, or if you just Google it, you would also be shown that page. Okay, so this is how you calculate the tax liability based on this question. Do you guys have any questions on this before we move on to question 4.3? Is there anything you're specifically wondering about for the dividends or the dividend exemptions, or how to calculate the tax specifically? Okay, so let's then move on to question 4.3. Okay, so question 4.3, what they wanted you is to know if an amount should be included in gross income. Now we said when we discuss if something needs to be included in gross income, we have to discuss the different components, the 5 components. But in this scenario, what they did is they went and split it up into smaller brackets, so each portion would be less than 10 marks. So what we said, in that case, we would have to only focus on the components which has an issue when we discuss this, because this is where the marks would generally be allocated. So let's quickly look at what was required before we look at the individual transactions. So the first one we said is determine in each of the above situations what amounts will be included in gross income for the 2021 year of assessment. Okay, so 2021 year of assessment would normally be end of February 2021 if it's an individual, and then they tell you ignore capital gains tax. So that means any amount of a capital nature, you would just have to state that amount is of capital nature and exclude it from gross income. We do not have to go and discuss the tax implication for any capital amounts. That is what that says. Okay, so the total amount was 20 marks, and we had 1, 2, 3, 4, 5 subcategories. Now, depending on the amount of information, you would look at about 3 to 4 marks per item here at the top. But generally what happens, if it's a small item, then it would be more like 3 marks, and if it's got more information, you would look like to 6 or 7 marks. But in the beginning, because you don't know how much information it has, I would work on about 3 to 4 marks per sub item, and then see if there's additional information that I need to put in to get to the 20 marks. Okay, so let's look at the first one. So there's 5 situations. They tell you that we want to know if it needs to be included in gross income. All persons are residents of the Republic. So that means we are taxed on worldwide income. So that means it doesn't matter if it's foreign or if it's local income, you will be taxed on both. Then let's look at what Grant Green is. Grant Green carries on a business as a second-hand motor car dealer. Okay, so he has a business as a second-hand motor car dealer, and he sold his private family motor for $130,000. Okay, now based on that information, what do you guys think? Do you think this would be included in gross income? And what would you potentially have to argue? Okay, so if we look at the definition, let's start with gross income definition. Okay, so we know he's a resident, okay? So we firstly have to look at, it's a total amount in cash or otherwise. Okay, so if he sells a car, you generally receive cash for it, okay? Then the second thing, is it in the year of assessment? So they haven't given you a specific date, but you would assume it's in the year of assessment. Has the amount accrued to him or been received by him? Okay, if you sell it, it would generally accrue to you. And then, is it of a capital nature? So the question here more is this car actually of a capital nature? Based on his type of business. Okay, so Estienne says he thinks the sale is not in the ordinary trade of business, it's a private sale. Okay. Magdalene thinks it is capital of nature because of the fact that it is a car. Okay, so this is where you will have to motivate. What? So this one could go either way depending on how you motivate it. So because of the fact that he is a second-hand motor car dealership, he will have to actually motivate that that sale of his car is a private sale and does not actually form part of his business. That car wasn't part of the business to start off with. Because if it's part of the business, it would be seen as trading stock, which means it would be included in your gross income. Whereas if it is a personal car, you've bought it separate from the company, it is not sold by the company at all, then it would be seen as capital nature because of the fact that it is not trading stock. Okay, So in this scenario, you would have to actually motivate what you say. So the first thing you have to do is you start with the gross income definition. Okay, so the first thing we asked when we look at Grant Green, if we do the definition, have we actually received or accrued this amount? Is the first thing you have to look. So you say the definition of gross income includes amount of a capital nature. So with a motor vehicle, we need to say that it excludes an amount or that's received or accrued of a capital nature. Now, firstly, based on your general assumption, you would think a car is capital in nature. But now you have to also mention the fact that this business, their business is selling cars, second-hand cars. So Grant will actually have to, normally it would be seen as capital nature, but he will have to prove that it is not profit making in scheme because of the business that he's running. So you then state the sale of his family car would be capital in nature, as he would engage in the operation of a proper. So he would have to show it is a private domestic asset and not a business asset. And then you also state that because of the fact that his business is buying and selling second-hand cars, it could possibly be that this private car is seen as trading stock for this business. So it might also be a change in intention. So initially he might have bought it as capital and then changed the intention of making a profit on it because he might be selling it for his business. So in this scenario, they're a bit vague, so it could have gone either way. But we would have marked how you actually motivate it. And we said when it is the intention, we look at the change of intention. The onus is on the taxpayer to actually prove that it is capital and it is not a profit-making scheme and that it should not be included in gross income. Okay, so that is what you had to sort of write down to get the marks for Grant Greens. So first you had to state that the car could potentially be capital nature. Then you had to talk about his business and the fact that his business is actually to sell second-hand cars. So there might have been a change in intention, but normally a car would be seen as capital nature. And you would need to prove that it is actually capital and not part of the profit-making scheme so that it's not included in gross income. Now, if we go to Sheila on the other end, they tell you Sheila owns a furniture shop in Bloemfontein, so she has a furniture shop. During the current year of assessment, she sold a bedroom suite to a customer for 5,000 Rand. Okay, the customer paid 4,000 in cash, and then she accepted a second-hand suite as trade-in for the balance of 1,000 Rand, and she later sold that for 1,500. Okay, so if we look at this one, what category or what component in our gross income definition would be affected? So what category or component in our gross income definition do you think will be affected in this scenario? Okay, so amount received or accrued. Okay, that's yes, so that's partially it. What's the main one you think will be affected here? If we look at the components. So our components is residence, but we know everyone's a resident, so we don't have to discuss that. Then you've got total amount, cash or otherwise. You've got the year of assessment. You've got amount received or accrued by, and then you've got excluding amounts of a capital nature. Which of those four components do you think will be affected? Okay, so SC on things excluding amounts of capital nature. Okay, so not in this scenario. So the one that would actually be applicable to this one is the total amount in cash or otherwise. And the reason I say this is because of the fact that they paid a portion of the price by giving them second-hand furniture to sell. Okay, now when we receive something that is not cash, we need to look at the value of the asset that would be included. And normally that would be the market value. So what is that asset worth currently in the market? And that is the amount that you would include in the gross profit. So in this scenario, they've sold a bedroom suite, which is trading stock. So they have actually sold it for 5,000 Rand. Now, of that 5,000 Rand, we received 4,000 in cash. So that is the amount physically received. And we received the second-hand suite. Okay, so we received something that was otherwise than cash, which was the furniture, for the balance of 1,000 Rand. But because we sold it for 1,500, that represents the market value of that furniture. So that means we actually received an asset which is worth 1,500. So the value we've received is actually the 4,000 plus the 1,500, which we would then include in our gross income. Now let's see how you would document this when you write it down in a test. You would first start with the definition of gross income, and you talk about the fact that amounts that have been received or accrued by a person in the form of cash or other than cash with ascertainable value. So that is the Butcher Brothers court case. So when a benefit has been received other than in cash, the amount is included in the gross income at its fair value. So you state that that furniture that they have received is included at the fair market value. Now, because we sold it subsequently, like very close to that date, that would indicate that the market value of that asset was actually the 1,500. So you first start with the 4,000 was received in cash as included, and it's not a non-capital receipt as it is trading stock. Then the 1,500 is the market value of your furniture and not the balance of 1,000 Rand. But if you stated you include the market value of 1,500, we would have given you the mark for that, even if you did not state the selling price. And then you state that how do we actually know the market value is 1,500? The fact that it was sold like 3 days afterwards is a good indication that that is the market value or what that furniture is worth. Okay, so that would have been an additional comment that you would have included. Okay, so based on this one, do you guys have any questions on the cash amount received in cash or otherwise, and how you should actually document it? Okay, I see we actually run out of time. What I will do is I will send the suggested solution for the other ones as well. Or do you quickly want me just to run through them and just... Okay, so Talia asked, with regards to the rebates, do we only have to know the 2022 ones or the 2021 ones? Okay, so Talia, normally we ask the most recent one, which is the 2022 one. But I just want you to make sure that you know the 2021 one as well, as I don't know which tables they've used. Okay, so you guys asked that I just quickly run through the remaining ones just to see just to discuss what you had to sort of look out for. Okay, so let's quickly run through the last few things, and then I'll send the suggested solutions as well and ask your teachers just to distribute them. If we look at Starling Limited, carries on the business of structural engineers specializing in erection of aviaries. On the 14th of February, let me just get a highlight here. So on the 14th of February, 2 weeks before the end of its year of assessment, it completed the erection. So with the dates, when they give you dates, you need to know it's the earlier of receipt or accrual. That is why we give you the dates. And then it needs to be unconditionally due. Okay, so in terms of the erection, in terms of the contract, 95 of the contract price is due and payable on the completion of the aviary, and 5% is retention of monies until the final certificate is issued. And that's generally 6 months after the erection. So what that means is that is a condition in terms of the contract. So because they've completed it on the 14th of February, you would then include 95% of the 100,000 in there because of the fact that that amount has accrued to you on the 14th of February when you completed the aviary. And then the 5% will only accrue to you once the condition has been met, which is the retention, the final certificate has been issued. So that would only be taxed then in the 2022 tax period, and that is what the marks would have been allocated for. Okay, if we look at Nightjar, Nightjar sells fashion garments, so we sell fashion garments. On the 25th of February, it sold a collection of outfits to Pretoria models for 60,000. In terms of the contract of sale, Nightjar undertook to deliver the evening outfits to Pretoria models on the 3rd of March, and the year of assessment is the last day of February, and delivery happened on the 3rd of March. Okay, now this one you have to look at accrued or received by. Now, on the 25th, we've concluded the contract. Okay, so in terms of the contract, we signed the contract, but there was a condition in this contract that for this contract to be finalized, we first have to deliver the outfits to Pretoria Model Agency, which only occurred on the 3rd of March. So we said with receipts or received or accrued, it is only included in the year of assessment where the condition is made. If there is a condition that is linked to it, we will only account for it once that condition has been met. So for this reason, we would only account for that 60,000 in our gross income on the 3rd of March 2020. So it would be in, oh, I see there's two dates here. Okay, that's the error there. It should be 2021. So we would only account for it in the year of assessment starting 1st of March 2021 up to 28 Feb 2022 because of the fact that we would have only met the condition in terms of the contract once we've done the physical delivery. So that means we would only be taxed on that 60,000 in the 2022 year of assessment. And then Bob Feldman requires a deposit of 5% on orders placed by customers for fresh eggs and farm chickens. If a customer cancels an order, they forfeit the deposit. And during the year of during February, he accepted deposits of 5,000 Rand and deliveries were made in March. Now, in this scenario, because of the fact that it doesn't matter if they continue with the order or not, even if they don't cancel the order, they forfeit the deposit. So in this scenario, you would be taxed on when you receive that deposit because of the fact that there's no further condition to repay it in terms of the contract. Secondly, that deposit is also not held in a trust specifically. So you've already received it. So you would be taxed in the year where you've received it rather than when the delivery was made in this scenario. Okay, and because of the fact that when they forfeit it, you still get that deposit, I don't have to pay it back. I will be taxed on that 5,000 Rand at that date. Okay, so let's quickly run through the suggested solution just for the other ones, just so you can see what the answers would have been like. So for Starling, we said the amount that accrued to Starling is the amount when it becomes unconditionally entitled to it, according to our Moy versus SIR court case. So that means that 95% of the 100,000 accrued to Starling on the 14th of February, and the remaining 5% will only then accrue once that certificate is issued. So therefore, 95,000 will be taxed in gross income in the 2021 year of assessment, whereas the 5,000 would be taxed in the 2022 year of assessment. If we look at Nightjar, we said Nightjar is entitled to the sale of the value of the evening outfits, which is 60,000, as soon as the contract is entered into, but they have an obligation to deliver the goods as part of that contract, and the delivery only occurred on the 3rd of March, and which is thus the date of the accrual for the gross income. So we will only include it on the 2022 year of assessment for that reason. Okay, and then the last one is your Bob. The deposits received by Bob represents an amount received as it was for his own benefit. That's the Geldenhuys case. And it's not subject to conditions, since you would forfeit it if you cancelled your order as well. And they don't have an obligation to repay it, so you would actually include it in your gross income for that reason, because it's been received. Okay, and if you then needed an additional mark, you could also have said, because it was not held in a trust account, it was received for the benefit, and you would also receive a mark for that. Okay, so that is question 4.3 in a nutshell. Do you guys have any questions on how to actually answer whether something is included in gross income or not, and how to structure that question?